Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to be walking you through some of the most interesting financial market themes that I'm observing. So we've been experiencing a large rotation in both stocks and bonds in the third quarter, much of it tied to the expectation that the Fed is going to be much more accommodative in the next 12 months. We talked last time about the expectations for the Fed to cut rates. They did, in fact, do that at last week's September Fed meeting, cutting 50 basis point cuts. We've actually seen long-term interest rates increase after the Fed cut. Let's talk about the implications and why that's not necessarily a surprise for us at Meeder. And finally, the market believes that the Fed is going to be much more accommodative or aggressive with rate cuts during the last two Fed meetings than the actual Fed told us they were going to be just last week. So large rotation in stocks and bonds in the third quarter. This data is as of September 26th, yesterday. Take a look at the two comparisons here. We have the S&P Information Technology Sector Index, the S&P 500, the U.S. 3-month Treasury bill that's basically cash returns. The Russell 2000, that's a small cap index, and the Bloomberg US Ag. Those are longer maturities than cash, investment grades, both corporate and treasury, so long duration. Now, in the teal, we have the first half of 2024 total returns for each respective index. And in the navy blue, we have the total returns for the third quarter so far. We've only got about a week left here of the third quarter, so almost wrapping up, and we can see some pretty drastic differences. Take a look at the first half of 2024. It jumps out at you. The S&P 500 information technology sector up 28%, S&P 500 market cap weighted, so you're getting a lot of those big cap, mega cap tech. We've all heard the stories about Mag 7 driving that up 15%. You see cash at a 2.6% versus that Bloomberg investment grade longer duration at negative 0.7%. And small caps only have 1.7%. So it was dwarfed by that large cap growth outperformance, specifically around technology stocks. In the third quarter, the market moved to starting to really buy in, and we had inflation come down lower. We had unemployment tick higher. Odds of the Fed becoming more aggressive with rate cuts started to come into the picture, and ultimately the Fed did cut rates in September and meet expectations with that 50 basis point cut. In anticipation, you see information technology performance not go negative, but very drastically lower. And Russell 2000 small cap stocks have outperformed. You can see cash is still trudging along at a normal pace. But look at that investment grade on the far right, 5.2% versus that negative territory. Rates went down. Longer duration outperformed significantly during the quarter in small caps, all in anticipation of the rate cut cycle over the next 12 months for the Fed. Now, interesting enough, if you look at the full curve, we've got four different maturities of interest rates here. These are all U.S. Treasury or U.S. interest rates. We have the Fed funds rate upper bound. Remember, that's what the Fed controls. It's an overnight lending rate for banks at the Federal Reserve Central Bank. That's all they control. And you can see that's been steady at 5.5% while these other rates have been moving in 2024. And you can see that 50 basis point cut down to the upper bound of 5% at that September meeting. But take a look underneath the surface. Number one, you can see, yes, in anticipation for this Fed cut, interest rates started to move lower in the month of May, June, July, and August for the most part. But since the Fed cut, we've actually seen the long end of the curve. That's the orange 20-year U.S. Treasury, and that's the green 10-year U.S. Treasury on the chart, move slightly higher, while the 2-year Treasury has basically gone flat since the Fed meeting. So two things. The market anticipated the Fed cut ahead of time, so we saw rates come down lower. The other thing is we've had a yield curve inversion, which means short-term interest rates have been higher than long-term interest rates since the summer of 2022. It was the longest inversion in history. And that ended during the third quarter when short-term rates started to come down much faster than long-term rates did. And you can see it on that 2 versus 10. That 10-year Treasury rate has surpassed it during the month of August, and it's actually started to climb. That's called the yield curve steepening. What that tells us is the long end of the curve was already suppressed in anticipation of some sort of a slowdown. The short end of the curve was really high in anticipation of the Fed increasing interest rates, or in accordance with the Fed increasing interest rates to combat the record inflation that we experienced back and peaked in 2022. But now short-term rates are going to be coming down over the next 12 months. Long-term rates don't really have much more to go down. And the fact that we're starting to steepen tells us that the long-term economic expectations are that the Fed is navigated the soft landing. We don't know if they have yet, but the market's expectation is that you're going to start to have that steepen. Short end will come down. Long end may not come down that much. We're sitting at about 3.7% of the 10-year. There's not a lot of room for that to come down relative to the Fed funds rate moving back to 3. So perhaps not a lot of downside for rates on the 10 and 20-year end of the curve, and yield curve steepening will continue. Now, we talked about expectations by the market. One of the best ways that you can gauge this is Fed fund futures. They are futures contracts that people can buy and sell to speculate on where they think the Fed funds rate will be at various months in the futures and various meetings. Well, if you remember, ahead of the September meeting, it was basically a coin flip, but it was favoring by about 55 to 60% right at that meeting that the Fed was going to cut by 50 basis point cuts. It was hotly debated. They ultimately did move toward that 50 basis point more aggressive cut. If you look at that next November meeting, remember, this is going to be the week right after the election, November 7th. The Fed is expected, but still basically a coin toss right now, of cutting 50 basis points. Now, let's take a look through the end of the year and then compare that to what the Fed actually told us at the September meeting. If you look at these Fed fund probabilities charts, let me just walk you through this table here. On the left, first column, we have the meeting dates. Those are all the meeting dates that the Fed could cut rates if they don't do any intra-quarter cuts, intra-meeting cuts rather, over the next year. On the column headers there, you have the different Fed fund ranges. So you see at November 7th meeting, a 54% chance of the Fed funds rate having a 50 basis point cut and a 46% chance of the Fed making a 25 basis point cut. In December, interestingly enough, we have a 98% probability based off market expectations that the Fed funds rate is going to end the year at that upper bound of 4.25. Now do the math, that's 75 basis points lower than it is now. That's pricing in at least 150 basis point cut between November and December meeting by the end of the year. If we looked at the Fed's dot plot, the dot plot is essentially each member gets a dot on this summary of economic projections that they put out each quarter over the year. September was one of the quarters, and we got their expectation for the end of 2024. Basically, the median was right into that 25 to 50 basis point cut, slightly leaning toward a 50 basis point cut by the end of the year. Market says you're not going 50, you're going 75. Who's right? Time will tell. And obviously, some of the data with inflation and the labor market will ultimately probably move the Fed one way or the other. There's some time to make that decision based on the data that we see with inflation. So far, inflation data has been continued to be very favorable. And if the unemployment labor market starts to show any concern at all, I think the Fed will be more aggressive. Right now, they're still in very restrictive territory with inflation 3-month annualized running at slightly below 2%, labor market back above that 4% unemployment rate, and the Fed funds rate at 5%. That's pretty restrictive relative to history. So the Fed does have some room to move lower. And I think the data of the next couple of months will ultimately determine whether we're at that 50, 75, or even 100 basis point below where we're at now if we start to see inflation improve and the labor market really worsen. I think the Fed's going to become even more aggressive. So if you look at Facebook, Meta, old habits die hard, still call them Facebook. Zuckerberg's Meta, right? Rename that. They revealed Orion, the name of their new augmented reality glasses, which allow users to view digital apps. Think essentially you're wearing glasses, but you can grab stuff. It's like Mission Impossible or Minority Report, all those 90s movies that predicted the future where you're just going to be like touching and moving stuff in the air. That's what it looks like to me when I've seen some of the videos. This is not going to be released to consumers yet. They're putting it out to Meta employees and certain external parties to get feedback to try to get it ready for consumers. Looks a little clunky to me, but if you compare it to Apple and some of those other products where it looked like they were wearing sort of underwater scuba gear, this looks pretty sleek relative. Still think probably the future is probably going to be moving to those contact lenses, so we're not there yet. But it will be interesting to take a look at what the future holds. It's going to be an interesting ride with the advancements in technology that we've seen really over the past several years around AI and obviously the improvement with semiconductor chips, computer processing power, and technology within the computer sciences. With that, I want to thank everyone for watching, and I'll see you next time.